Hi, I'm Paul Goranson. I'm the CEO of enCore Energy Corp. We're what we believe to be the newest producer in the United States. We expect to start production in 2023, and we've been growing our assets not only through organic growth of our current properties, but through mergers and acquisitions over the last 2 years. Most recently, the Azarga uranium transaction that really expanded our growth profile in the United States.
Paul, good to see you again. I haven't seen you since March. What a year. It's been a kind of a little tumultuous, I think. Russia, Ukraine, thrown a spanner in the works, and we've had to rethink how we come out of the space. So when we spoke last, you kind of built a sort of picture of what was going on and what you were trying to be. You've obviously raised $30 million since I last saw you. Got a few deals over the line, and you've got a few new appointments. So, how are things on the ground over there?
Well, they're going very well. It's we built we targeted for production in 2023, and we've been, since the last time we talked, we've been doing some significant acquisitions of uranium properties in Texas, and that has led us to start building a stable of uranium projects that can feed our Rosita plant. We've nearly completed the Rosita construction, the upgrade and modernization. We had some supply chain issues along the way, like the rest of the world did, and we started expanding or developing our first well field to get geared up to go into production. Of course, as with anything, you're trying to gear up. We're locating drilling rigs to do the well field installation, hiring critical staff. We've done some major additions to our technical team. We brought on a COO, Peter Luthiger, and we also brought on a Chief Administrative Officer, Greg Zerzan, who brings these two bring a lot of wealth in the execution phase of what we're doing right now. And so it's pretty exciting. And, when we last talked, we were working about the general fundamentals of the uranium markets. And as you mentioned, with the changes in the geopolitical situation, all our expectations we had last time we talked have changed dramatically since then. So we're also weaving and dodging all these things that are going on, trying to build the best strategy we can in a changing environment.
Yeah, changing for sure. A lot of moving parts in what you just said there. And if you don't mind, I kind of initially want to focus on what you've got and what you're trying to build. And then maybe we'll later come on to how you insert yourself into whichever ecosystem you're going for. I suspect the US, clearly. So the Rosita plant, what's the capacity there? How much do you need to be able to feed into that to get operating at optimum levels?
Well, the Rosita plant currently has a production capacity of 800,000 pounds of uranium per year. Has capacity to do more than double if we decide to add the equipment. And in fact, we've already started to do the early procurement for the increased capacity at Rosita. We haven't fully executed on some of the major components yet as we try to identify the right fit. But that's the capacity right now. And so our production plan right now is to fill up get to capacity, so that when we're at capacity, we have the ability to take advantage of the investment that we're going to be putting in and increasing capacity. We can't forget we also have our Kingsville Dome project that has its own license capacity of 800,000, not license, but production capacity of 800,000 pounds a year. That is also an option where we can just move material to Kingsville as well, and do production there as we increase capacity at Rosita at the same time. So if we hit our marks, everything will be done through Rosita. But if things come in much better than we expected, we have the ability to use Kingsville Dome as our production option.
Right. So there's a few options. Okay, double Rosita, I think we did talk about it last time about getting a second plant into production. It just depends on what's happening in the market, and obviously a lot has happened in the market since. So you're not processing yet at Rosita, are you?
No,
right. But you're in ready state for it. 2023, yeah. Right? Okay, but you haven't done any test work through the plant.
We've done some limited work right now. We have a bit more work to do on the dryer side. We've got to finish putting in some the insulation and some pumps, et cetera. But we've received all the equipment we need. It's just putting it in place, and It's a little later than we would like to have had, but it's certainly, there's nothing that's going to delay us from starting up on schedule.
Right. Okay. And what's given you the confidence to do this? Because most companies, CEOs come on here slightly terrified of actually having to do anything like start producing because they're unsure of the market. The go-to is we need term contracts, right? We need term contracts at a set price. That price has been moving over the course of the last, well, let's say beginning of the year for sure. Well, during COVID, inflation, supply chain issues, but then obviously laterally the Russia-Ukraine situation has put a new spin on things too. So why kind of press that button and say, do you know what, we need to be primed and ready to go in 2023? Why not wait like the rest?
There's two reasons. One is that we already have contracted volumes. So we have deliveries starting in 2023. Now, there's flexibility built in those contracts where technically we wouldn't have to produce to sell into them, but we get a better margin if we sell into those with produced pounds. We have also, as we have announced, we've have a couple of utility contracts we've also used, put in place starting in 2024. And those provide as I would say, the committed demand that we need to make that production decision. When the price exceeded $40 a pound, we made that decision. We're going into production, hell or high water type of thing.
Why? Tell me about that, because for $40 a pound, that's nowhere near what people are talking about. That it used to be 55, 60, now it's 70, 75. So is it a case of it's good enough, we can clear enough margin here, but more importantly, prove a route to market? Was that the intent?
Yeah.
And get first mover advantage?
I would say that the decision was made that although we would still have a decent margin, it's not going to be a great margin at that $40 price, but we also had to prove that we could do what we're going to do. Keep in mind, as enCore is a relatively new company within the uranium industry in the United States. And as a result, we have a lot. I don't think we have a lot to prove, but we want to prove that we're able to deliver and meet our timelines.
Right. So proof of concept, and more importantly, make sure the plant is working and therefore can be upgraded too. Or you can double capacity in that sense. Can you talk about the contracts? So how much of that was in your hands in terms of were they binding contracts on your part, or were they options at whatever the
No, they're binding
level?
Contracts. So
right,
they're all three
how big?
are tied to market prices, and one is one contract we have, which we announced in detail with UG USA, is strictly a spot price with a slight discount off a spot for deliveries, and that's the one that has the most flexibility. And then the utility contracts, they have floors and ceilings in them, but they're market related, and the ceilings are well above today's spot price today. So we'll see additional as the spot price. We'll be able to see improving revenue when the spot price moves up. But I did that to assure that we have a committed buyer. If you've been following the spot market lately, the real committed buyer has been Sprott or Sprott Physical Uranium Trust. And when they're not in the market, the price gets real soft, and because there's no real demand. Now that will change, but if we compare it to today, by doing what we're doing, we have committed offtake, and that way, if we don't have to go find a place to fit in the market when there's no demand, we already have committed demand, and that's why we set these up.
Right. Okay. And so, how many pounds are you talking about in each of those instances?
For 2023, it's 400,000 pounds in a year, and then we advanced to 600,000 pounds in 2024, and in 2025 it's 700,000 pounds, and stays there about that through 2027, and it drops off because the UG contract drops off, and but we're already working to fill that gap beyond that right now to replace the UG demand.
Right. Okay. So obviously getting into production will prove to other utilities that you're capable and gives them the confidence that they can write bigger contracts with you, not in terms of, hopefully dollar terms, but in terms of pounds, amount of pounds. And during that period, you're looking to obviously drive efficiencies through the plant by either doubling output or actually just weeding out some of the issues that there always are with startups. Okay, good stuff. Can you tell us about some of the acquisitions? Because I'm trying to work out the size of the portfolio, how you go about working out which ones will produce the pounds, which one will produce the pounds economically or more economically than others, and which ones perhaps need a little bit more work. I mean, how do you view the portfolio?
So what we've done since last time we talked, when we last talked, we completed the Westwater acquisition, and since that time we've completed the Ozargo uranium transaction. So that gave us production assets in South Dakota and Wyoming, in addition to what we're doing in Texas. But I'm going to focus on Texas right now. We have, since we last visited, we actually went out and acquired uranium mineral properties that have been previously permitted and licensed. We've got that done, and we've started the permitting process right now to bring those under our current licenses at Rosita. But that was a significant, we haven't published any numbers on it, but there's significant historic uranium resources in there, which would, with all of our Texas assets put together, will fulfill all of our contracted uranium demand through the end of the contracts, so that we'll have enough resources, more than enough resources, to be able to support that demand. On top of that, that's starting in 2023. We'll be announcing more resources, et cetera, that will be coming online in 2024, which will be, as we talk about this increasing contractual demand, that's where we're filling it from. And once we have that put together in a public document, we can talk more freely about it. But on top of that, we also have the fully licensed South Dakota Dewey Burdock project in South Dakota, which is one of the best projects out there. That was that we acquired through the Ozargo uranium project. Granted, it has had some permitting and licensing lags and timelines, but from a fundamental operational economic basis, it is a very good project. And it's the PEA has it that was published by Ozargo, indicates that I believe at a $55 per pound market, it has a significant net present value and a good internal rate of return. And I'm not going to quote numbers because I don't remember them right now. And then coupled with that, and almost on us, is the Wyoming property called Gas Hills, which have substantial resources. All those we saw is kind of building that production level, and the timing works out. Assuming by 2025, we'll be able to start developing either South Dakota or Wyoming, whichever one meets that threshold with respect to the permit and licensing. Because we've already started preparing the permit and licensing for Wyoming right now. It's one of the other activities we have ongoing, and so we want to be able to continue to have additional capacity, not just in Texas but elsewhere. So we have multiple production centers, and that provides a lot of.
Okay,
go ahead.
No, I was about to say. Okay, I mean, congratulations on the decision by the U.S. Court of Appeal on the Dewey Burdock license. It obviously in your favor. Good. Do you think there's going to be any sort of further issues with the Oglala Sioux tribe there? I mean, or is that matter now closed?
I won't say there won't be. I believe that with respect to the legal actions that are going relative to the permits and everything, we hit a major milestone on August 9th when the D.C. Circuit Court of Appeals gave a decision on the challenges to the Dewey Burdock NRC license. Granted, there's an opportunity for them to appeal, but we believe that based on the strength of that decision and precedence, that even if there's an appeal process, we will prevail on that. But the challenge, what it does is that the other permitting, the EPA, which is all process, we have a aquifer exemption and a Class 3 injection permit that were approved by EPA and signed off, but are being challenged by the tribe as well. But the interesting thing is the same contentions that the tribe is challenging, those two permits are the same ones that they were currently decided upon by the D.C. Circuit. So once we determine if there's going to be a continued appeal of the NRC D.C. Circuit, If once it's, hopefully we find out it's not going to be appealed, and if that's the case, then the EPA process can immediately start based on the outcomes of that decision. And so we're expecting that to take 12 months or so to get through the process. But everything, typically the chicken and egg, it feels like sometimes. You got to get one step done first before you get the other one, and the other one can't happen without that one, and et cetera. So we know the process, we know the players, and so I have high confidence we'll prevail. And that does, but always, because you're dealing with courts, with all this stuff, there's always a uncertainty on timing, not necessarily certainty on the decision, certainty on timing. But that's the other reason why we're advancing the Gas Hills project at the same time, because the state of Wyoming is an agreement state, so there's very little federal review. And we believe that we'll track that at the same time. And so if I had to bet, it would be a horse race between Dewey, Burdock, and Gas Hills when they come into when they meet that production timeline. Meanwhile, we're continuing to add assets in Texas that can fill and continue to expand our production out of Texas as well over that period of time. So I see us advancing on three fronts. No one front is dependent on the other front to get to the company strategy.
Okay. Okay. I understand. I get we have so many conversations around companies' views on how long EIA permits are, or DIA, depending where you are in the world. Same thing. First Nations issues are on the rise. You've got ESG concerns across the board and NGOs and so forth. It's a much longer, more difficult road, and I guess it's we look to see how companies navigate those roads. So that's a good start. Good luck with that one. Just on there's another conversation going on out in the market, which is this kind of high grade versus low grade, and sort of ISR sort of sits, I guess, slightly off to one side in the sense that because of the kind of low capex component, the grade isn't a conversation that you come across very often. But what sort of grades are you talking about, and what do we actually understand about the economics of the different projects?
Our grades are relatively low compared to what we're used to hearing, let's say, out of the Athabasca Basin, et cetera, and some conventional projects. We're certainly well higher. Our grades are stronger than what we see coming out of Namibia. So our grades typically run about 0.1, 0.09, maybe a little higher on average for our ISR projects. And we have a cutoff grade of, obviously the cutoff is 0.03%, but on average we're closer to 0.1% on average. And that's what we need there's reasons why, not only just as we talk about grade relative to cost, et cetera, but the grade also drives how efficient the reaction is in the in situ recovery side. It's not just a chemistry, a leaching chemistry thing. It's also kinetics, and the higher the grade, the easier it leaches, the faster it leaches, and the less cost it takes, because the whole plant recovery side, that increases your whole plant average grade. That your chemical use is much more efficient. So around that 0.1, it actually works really well for ISR. When you get into high grades in ISR, and that's like closer to 1%, and the geochemistry and the geology of the typical ISR deposits, which are redistributed ore bodies, there's a reason why that grade is there, and it's probably not because it's amenable to ISR mining. That uranium stayed there and stayed locked in and didn't relocate. And so when you get too much grades that are significantly higher than 1%, the ability to leach goes down significantly.
It's an interesting conversation, isn't it? Because I guess to the majority of people kind of looking into mining, new to mining, which is an audience we try and bring in here from other verticals. They would hear the chant, grade is king, but it isn't always necessarily the case. It's one out of many factors, and I just it's good to hear you sort of talk about, obviously what's important to you guys. I mean, obviously the other kind of factors in terms of where you are, infrastructure, skilled staff, etc. Has that been a problem during this kind of COVID-ridden time?
Yes, there have been challenges, and that's mainly in the technical field, like for engineers, geologists, heck, even accountants. But from the field, from the trade area, the trade skills, that has not nearly been as much of an issue as that one might think, because where we're located, particularly in South Texas, is that there's a significant of infrastructure built around the oil and gas industry. And if you think about oil and gas wells and how those operate, it's not it's a significant scale change to go to in situ recovery. But from a skill set basis, I can take a worker who's worked in the oil field and move them as an operator for us, and it's not going to take a dramatic change, a really steep learning curve outside of just changing the procedures and processes that they go through. I find that their skill sets are easily transferable from the oil and gas industry to our business. It's almost seamless. And then it becomes a matter of pay scale at that point, what you can do to attract people.
Right, and that's one of the areas which I guess one, it's difficult to staff, but two, the kind of cost of that staffing. And so generally, inflationary environment, you're looking to get in production next year. Were you able to lock in prices, or did you take a bit of a hit in terms of the Capex for some of this, or will you take a bit of a hit in the Capex?
So our Capex hasn't really taken, well, obviously the costs have gone up. I'm not going to deny that. But I kind of, when prices were increasing, it's just like with any other type of commodity purchasing. PVC was a commodity I was acquiring. And so I basically fixed a price on what we needed, all the PVC casing we needed for our well fields, by buying an entire production run from the manufacturer. I had to go to alternate suppliers out of Mexico versus out of the U.S. for normal suppliers, simply because there's so much demand out there we're competing with municipalities and with other industries at the same time, and the U.S. government. For a lot of the same materials, we have to come up with alternative suppliers. But I was able to lock in prices by buying a production line. I've done that for several components that we did. We made a decision to buy early, fix the price, and prepay. Granted, in the past, we would conserve cash and basically buy as we needed. That's not an option these days. So we had to convert our cash into actual material, and so we could secure our production.
Right. Okay. So I guess carefully managing the capital at the moment. I want to talk about some of the conversations coming out of the WNA last week in London, which were very positive. Everyone was in a good mood. European and US utilities alike were there. We also had Dr. Catherine Huff from the US Department of Energy there, who stood up and said that the US needs to double its nuclear energy production by 2050. I thought, okay, that's a bit aggressive. What are you going to do about it? And we said, well, the funds and the incentives will be there. We also talked about the uranium reserve, which is, again, interesting that they're having that kind of conversation in public again, and that very much the enrichment problem was something that they wanted to solve. But what are you, as a CEO of a U.S. uranium company and U.S. domiciled assets, as it were, what are you actually hearing from the government? Is it just politicking, or is there actually genuine help or concern from the DOE and anything that you can take advantage of, quite frankly?
I don't think it's politicking. I think it's real. I'll give you a bit of an anecdote about it. Is that when obviously when the Russia invaded Ukraine, it created all kinds of disruptions in a lot of different markets. Uranium, nuclear, even getting material out of Russia, enriched material, that made some headlines for a bit. It created a wake-up call within the U.S. government that, paraphrase, hey, we got a problem. Or they pitched this $4.3 billion LEU, low enriched uranium, HALEU, high assay low enriched uranium purchasing program, kind of generally, and didn't really give a lot of meat to it. And subsequently, with trade associations meeting with DOE folks from DOE, it's effectively basically an outgrowth of the Nuclear Fuel Working Group recommendations and back in 2020 that are effectively on steroids. So in other words, to something that they thought was going to take 15 to 20 years to accomplish, DOE is advancing that to 5 to 10 years, if you understand what I mean. And so it's what the intent is that to actually buy low enriched uranium. I'm going to stay with low enriched uranium to build a bank in case of supply disruptions, and that the U.S. government would be the highest, basically the buyer of choice in the market, so that they would incentivize increased enrichment capacity and increased conversion capacity, which are the key right now, the kind of the weak points in our supply chain we've allowed to atrophy over the last 25 years. But because it's the U.S. government, they have to buy U.S. origin material for anything because that's what the U.S. government does. So I see that as a knock-on effect for the U.S. suppliers like us. And I think that the DOE will end up placing a premium on U.S. material to support new production. That's all at the same time where we've got utilities that are also looking for domestic Western enrichment and everything. So you've got the U.S. government that's effectively going to be a competitor against our nuclear utilities, and the utilities competition effectively has no cost limitation. They can buy at whatever price as long as they spend the budget. So right now there's a $1.5 billion emergency request in front of Congress that the DOE put in as part of the administration put in as part of the Ukraine aid bill that's intended to do exactly that, is to incentivize new enrichment and conversion capacity, and ultimately that will tie to increased U.S. demand for U.S. uranium.
Right. But that takes a while to get in place, right? So the next 3 to 5 years, and assuming governments remove all the kind of red tape usually involved with permitting and licensing for such things, it's still going to take 3 to 5 years. What's the short-term fix for the U.S. government in all of this?
There's not a real good short-term fix that the U.S. government can provide. It's going to be the commercial industry. It's going to have to drive that fix. So there's going to have, already you see signs of that. Enrichment capacity can be increased by increasing tails assays. So instead of having a 0.16 U-235 tails assay, increasing that to a 0.2, 0.25, or 0.3 U-235 tails assay can improve the amount of enrichment, that enriched LEU that's coming out, but it puts more demand on conversion uranium. But the expectation is that there will be more conversion coming in the market. Again, it's one of those things that, I didn't go to WNA, but I went to World Nuclear Fuel Markets in Montreal back in June, and the conversion suppliers and the enrichment suppliers saying, we will deliver that capacity if you'll give us term agreement, price the demand and give us locked in, because they don't want to make the commitment if everything's going to back to the way it was prior to February 24th.
That's happening all around the world. It's happening in the battery metals space as well. It's like the knock-on effect further down the supply chain. It's people needing assurances and guarantees, which very few can give around the kind of the supply in terms of price. And demand obviously seems to be there for almost any metals you look at the moment. So that's kind of interesting. So the US is between a sort of rock and a hard place at the moment, but eventually the beneficiaries will come down to companies like yourself in the US in terms of domestic supply. But are there any kind of assurances now or is it really a case of wait and see how this plays out? I'm trying to get a sort of sense of timing, as every uranium investor is, as to how this plays out and when.
Well, with respect to obviously we know. Let's set aside the government program that's going on, which I believe will be a put in place. On the current short-term side, we're starting to see some of those assurances. And I can't speak on behalf of conversion and enrichment, but I can talk on our behalf. Is that we've seen quite a bit more utility inquiries into getting supply. I always tell people is that prior to February 24th, I had to call the utilities to set up meetings or get phone calls with them to have a conversation, and now they call me. And I'm not saying that's a great thing or not, but what I'm getting at is that it's just changed the dynamics. And so a good example is we announced, even though it was a small contract back in July, I would say that one of the outcomes of the changing dynamics in the market is that we were able to secure a term agreement with a small utility that probably would not have thought about it prior to February 24th, or it would not have been a priority for them. But they made it a priority for them to secure that supply, domestic supply. And I wouldn't say it was done in desperation measures. It's probably about planning and transitioning away from the former supply chains. There's not a rush to the market by the utilities for uranium. There is for conversion and enrichment. If you look at conversion and enrichment prices, they have spiked. And that's because there's intense demand and competition for that capacity. Uranium will come with that demand. Once that demand is secured, then the uranium has to be purchased to fill that capacity or that what they've purchased. And so we're starting to see a lot more inquiries and inbounds from nuclear utilities with the ones that have been kind of doing what I would call providential planning. They started seeing things going one direction. They started locking in various supply points along the way. Now, but the follow-on is, okay, now we got the central part of the supply chain secured. Now we need to get the feed. That's what we're starting to see now. And I see a lot less resistance to higher prices. They're willing to secure higher floor prices for contracts. And what's been helping is the fact that now we've got real reporting on what costs look like. TradeTech does a monthly report that does an assessment on production costs around the world and incentive prices, and that's helped provide something that's not just my numbers, but someone else's numbers that can help supply that position.
Yeah, we were talking about, we'd run a weekly energy show talking about nuclear and uranium every week. And it's been it's quite interesting sort of looking at the trade tech or trade bodies. There are a couple, pick the one you like. The way that they are forecasting the movement of these numbers. But I guess the interesting thing for companies like you is, how does that affect margin? Because as prices go up, costs are going up as well. And you know, it's all kind of relative. So how do you get a sense of what that's going to look like, projecting out your own numbers in terms of your cost structures versus what you think the whether it be the term prices are, or if you sell at spot, what the floor prices are for that. Is that something that concerns you guys much? I know we talked about it at the beginning of the conversation, but it's you kind of got to have a view on how the economics stack up and continually reassess those economics in this environment, don't you?
Well, obviously it concerns us, the increasing cost, and I will say that we do a constant budgeting cycle so we can get an idea what our cost is going to look like, and it does get revised. There is an increased cost, but we're still, I would say, because we're blessed with not having to spend a lot of capital on our South Texas projects, and the fact that our ore bodies are really well understood. We don't have to do a lot of advanced work on them because there's been a lot of work already done. And they're relatively shallow, and the grades are decent. And so we can be competitive. We even with the current floor, I mean not floor price, but say TradeTech's production price index, we still are well competitive below that number. And that's because we're very fortunate with the assets we have. And that is what I believe gives us an advantage right now. When you got some of our competition saying, well, we need something with a seven handle on the price or a high 6 handle. I will take those, but I don't have to have those to make my production decision because I will make money at numbers lower than that.
Right, and how does the financing thing work? Because obviously it's a lot less capital. Presumably the capital providers, in whatever shape that money comes in, are going to like the fact that it's less capital, and therefore the cost of capital will also be reduced somewhat. Is that true? I mean, where are you with those sorts of conversations in terms of the type of money you want?
Well, on the cost of capital, it's a moving target right now because with the markets, the overall markets overall drive a lot of that sentiment, and so what we're doing we've seen obviously higher increases in interest rates, so that means that any debt you take is going to have a higher cost associated with it than what we would see a year ago or 6 months ago, for that matter. But also with the weaker, just the downturn in the overall markets. It creates a situation where you've got a little less enthusiasm about the sector because of the fact that the equities are down as a result of various market trends, et cetera. So the cost of capital has gone up. So the way we're mitigating that is a couple of ways. One is that we're managing our capital expenditures and trying to keep those as low as possible so we don't see a surge in that. The other is we're looking for alternative ways to get capital, like potential for forward sales of uranium as a means to basically securing capital through future production as a potential. I won't say we've done that yet, but that's some of the avenues we're looking at as alternative type measures, means for getting capital, so we don't have to go out and, for lack of a better term, basically go out and do a large equity raise, so we can minimize that cost of capital that's driven through that side.
Well, you can thank your lucky stars you're not dealing with FX as well. It's all dollars.
Yeah.
So I think that's affecting some people. Okay, and in terms of again, just sticking with the economics, if I may, in terms of the economics, how does this kind of spoke and hub setup work? Because you've got one plant, well, potentially a second one coming online as well, but you've got multiple assets, right, of a certain size and of a certain grade. Does there a point where there are some economies of scale on that, because you can move wells around, or you can move equipment around and move people around, or do they kind of sort of have their own balance sheet?
For lack of a better phrase, the hub and spoke approach has a lot of advantages going for it. One is that I can put smaller. I can go on to what I would call smaller deposits, so I don't have to have massive scale to support the infrastructure that backs it up. So a good example is that we have these small satellite plants that came when we acquired Westwater. They have these 1,000 gallon per minute satellite plants that are modular in size. They're already acquired. We'll have to buy pumps, et cetera, but we can pick those up, put them on a trailer, and move them to another location as we deplete well fields. And that's a cost of capital. That's a cost efficiency there. The other thing is, once the uranium is loaded on the resin, the ore body grade is immaterial, because the resin has the same grade as it loads up. It has a certain loading capacity, and when it loads up to that level and is sent to the plant, central processing plant like Rosita, all the resin that's coming in, regardless of the location, it could come in from 3 or 4 different locations, and it's going to be the same uranium, same grade on that resin. And so at that point, it pretty much homogenizes for the plant, and for the uranium circuit, and also because of selectivity of the ion exchange resin, we don't get different contaminants from different locations. So the hub and spoke process works very efficiently. It's been successfully done in Wyoming, and in my case, it allows me to go to multiple. There's not a lot because Texas is broken up buy a lot of private lands. There's no federal lands or no significant federal lands or state lands where we can go get basically secure large swaths of land to build a package or a whole project to support it. We have to go and look at discrete areas. It allows me to go and target a well field that may, or put in a project that has 1 million pounds on it. At the same time, I'm developing one that has 4 million pounds on it. And another one could have 2 million pounds on it. But the cost for installing the one for 1 million pounds is the same Capex as it is for the two, because you're using the same equipment and all you're doing is adding equipment for the larger deposits. And it works out very well because it's scalable. And that's the beauty of it. It makes all things equal. Now, grade always will be different because you're different deposits. And that'll change things in depth and everything else. But overall, it brings about its own efficiencies because of the fact that it creates kind of this clearinghouse for different ore bodies without upsetting the processing circuit.
Right. Okay. Interesting. And maybe something we come back to another time, because there's quite a few topics we want to come back to another time. So it'd be interesting to get into the weeds with you on that one. But I kind of tip my hat towards the fact the consolidation in relation to the NASDAQ listing. So that's got to be good news for you. Obviously, the rollback connected with your share price needs to be at a certain level to get the institutions interested. So how many conversations with these larger institutions you're having? Because your aim's always been the sort of poor cousin, as it were. It's a very small space, very small sector. The companies weren't big enough. The liquidity wasn't there. Is that slightly changing? Are you seeing some of these generalists come in now?
We haven't yet, but we will once I would say, as we actually hit that mark onto the NASDAQ. When we talk to folks, large institutions out there, there is a very positive reaction to our getting on a senior exchange because they have restrictions on, the venture exchange or share price and everything else. So the consolidation was key. I think that everybody recognized that we needed to do it. And then also that we believe that the NASDAQ is, whether you're going on NYSE or NASDAQ, everybody has a different opinion which one's better. But we get exposed to liquidity, but also there's more institutions that are watching those senior markets than would be on the venture. And obviously OTC, you won't get institutions really looking at that very closely. So we think this is a big move for us. And it's exciting. We watched we did the share consolidation. You watch your price and everything else, and keep your fingers crossed and all that. And now we just got to finish up. If everything goes, we're working on getting all the paperwork done for the SEC approval right now. But it's all looking good, and we're very excited about it. I am.
We should be. I think that's a really big move for you guys. It's also quite a big move for uranium more broadly to be on the NASDAQ, and people, the right people, or the big guys, having a look at this because they're certainly writing it up, and that's interesting. The way the bank's narrative has changed, and they're actually paying attention, they're making comments, and they're allocating analysts to write reports on the thesis here, which is something they haven't done for a long time. And likewise, I think a lot of the politics too, the narrative has changed. This energy crisis has given nuclear and therefore uranium the boost that it needs. So now you just got to take advantage of it, Paul. That's all.
Yeah.
Easy.
We're going to do our best to do it wisely and as effectively as possible.
Exactly. We love efficiency. Okay, so I appreciate you making your time and coming and joining us and sort of sharing your thoughts on not just the market, but how you're going to go about and take advantage of the situation whilst the sun is shining. So, Paul, thank you for your time today.
Thank you. I enjoyed it very much again.